Hello, everybody. Wanted to give you a quick update on capital gains. This is what we're going to be discussing this week, and so I just want to give you a quick review here. Now, recognize that the capital gains tax has been around since 1913, and it started out simply as the same rate as the regular income tax. It was modified, and then during World War I, it rose as high as 77%. Well, of course, when the tax rate gets that high, people stop selling things. It's just too much. And it became very apparent that people weren't going to sell assets if they had to give the government 77%. So that stopped. And when the sales stopped, revenue stopped. So what do we do for capital gains? Well, it's anything that you own for personal purposes or investment. It's a capital asset. And examples of capital assets are your home, your furniture. People mostly think of stocks and bonds, mutual funds, rental real estate, things like this. This is what we think of as our capital assets. So if you sell a capital asset, you could have a capital gain or a capital loss. Now, how do you determine that? Well, you have to know how much you paid for the asset you sold. Let's say you sold some stock. If you sold the stock for more than you paid for it, you've got a capital gain. The difference between what you sold it for and what it cost is the gain. Alternatively, if you sell a capital asset for less than the cost, you have a capital loss. And capital losses offset capital gains when they occur in the same year. So you net them out. Now, after you net them out, you either get a net capital gain, the amount by which your capital gain is more than your capital losses, or a net capital loss. Now, if your capital losses are much more than your gains, you could deduct up to $3,000 of them on your tax return. If it exceeds that, you can't do it. The $3,000 is the annual limit. $1,500 if you're married filing separately. So I have clients who have $200,000 or $300,000 in stock losses, and they can only deduct $3,000. And then the excess is carried forward to the next year. And then you can keep using it at $3,000 a year, or if you have capital gains in the future, you can offset those gains with the loss carry forward. And you just keep carrying that loss carry forward until you use it up. Now, no matter how much you make in capital gains, you simply pay the tax. There's no limit on the amount of money you can pay tax on. Now, when we talk about capital gains and losses, we're going to classify them two ways. They're either going to be long-term or short-term. Now, if your holding period, that is the day you bought the asset, and then you sell it longer than a year that you've owned it, so you've owned it for more than a year, you have what we call a long-term capital gain. If you hold it for a year or less, you have a short-term capital gain. Now, eventually on the tax return, all long-term gains and losses must be matched together, and the short-term gains and losses are matched together on the tax return on Schedule D. And you net out your short-term activity, you net out your long-term activity, and then you come out with a net capital gain or a capital losses. And capital losses are fully deductible against gains on Schedule D, and you can deduct your $3,000 maximum per year, and the remaining losses carried over to the next year. Now, the thing I want you to know, which is of significant importance, is that if you can have capital gains that are long-term, so you've held the asset for more than a year, you're going to get a beneficial tax rate. So how do we determine the holding period? So for real estate, and for anything really, the holding period starts after the date of acquisition. And it ends on the day you sell it. Now, most of the time, my clients, we're not really counting days. Most people own things way beyond a year for the capital gains. It's not really an issue. What if you inherit some property? Section 1014 says if you inherit property, the property in your hand is automatically long-term capital gain property. Automatic holding period more than a year. If someone gifts you property, your holding period is your holding period plus the donor's holding period. So if someone gives you some property and they held it for a year, you get that holding period of more than a year. If they held it 6 months, then you get 6 months plus whatever you hold. Now, what's the advantage on having long-term capital gains? Well, the advantage for the long-term gains is the tax rates. If you have a capital gain that's long-term and you're in the 39.6% tax rate, you're only going to pay a 20% tax. That's your maximum capital gain tax rate, 20%. What if your regular tax is 25, 28, 33, or 35%? Your maximum capital gain tax rate is 15%. And what if your regular tax rate is 10% or 15%? Then your maximum capital gain rate is 0%. And that's for long-term gains. So that's why it's so significant and so important. If you can have long-term gains, you're going to get the beneficial rate. Look at this. If you're in the 39% bracket and you have a long-term capital gain, your rate is only 20% on that gain. The same thing down here. 35%, 33%, 28%, 25%. Maximum rate you're going to pay on that gain is 15%. And if your regular tax rate is 10% or 15%, there's no tax at all applied to that long-term capital gain. So that's the importance when you talk to people and your clients. Let them know if they can have their capital gains be long-term, they're going to get a real benefit. They get the beneficial tax rate. They save a lot of taxes. That's why in tax planning, you have to help people recognize that the greatest benefit is capital gain, long-term capital gain rates. That's it. Take care.